Well, welcome to our session. My name is Mike Coscetta. I'm the head of revenue for Paxos. We're very excited to be here, especially because today we just received some amazing news from the MAS of our full payments license in Singapore. So good day to be here, and I'm glad you threw this conference just for us to announce our news. But we have an important topic about bridge to Web3 and really talk about how to make the journey from traditional finance into the Web3 world. And I guess just to gauge our audience, how many people here work for either a crypto company or a Web3 native company? Okay, good, because I still don't know what Web3 is anyway, and I don't think anyone actually does, but we're all figuring it out at the same time of how this world is continuing to evolve. So we have a pretty packed agenda. Just a brief introduction about what Paxos is and some of the themes that you'll see throughout this presentation. It's really to re-platform the entire financial industry and to allow the movement of any asset, anytime, in a trustworthy way, which means 24/7 movement of money, which means secure movement of money, compliance, and we'll walk through all the different components that today are assumed to be a required element of a Web3 experience. Who we are? Paxos itself, we're a 10-year-old company. We were founded in 2012, and actually we were founded right here in Singapore. We were built as the first regulated crypto exchange in the world, and we've had a 10-year operating record in Singapore. We've grown and morphed across the years into several other areas of business. We now have over 350 employees globally across New York, the UK, Singapore, now also Brazil, Argentina, Israel, the UK, Ireland, Northern Ireland, and soon to be many more as we continue to grow our global presence. We've raised over $540 million from several prominent venture capital companies, and we have about 24 billion under custody today, a big chunk of that being BUSD. We issue Binance's stablecoin. We white label it through our own platform, and we'll talk a little bit about what that is and how stablecoins really incorporate themselves into a Web3 experience is a really critical component to that. Who will be here today? Rich Teo is our CEO of Asia. He's currently meeting with the MAS, so we're not sure if he'll actually be able to make it, but you're stuck with me and my partner in crime here, Hongzhe. Hong runs all business development for us across our crypto brokerage and our stablecoin business. So what are we going to walk through? We're going to talk about some of the history and current state of blockchain and Web3. We're going to talk about digital assets in a regulated market and how regulation does play into really the mainstream growth of crypto and of digital assets across the world. We're going to talk about stablecoins specifically, and more specifically how enterprises and regulated financial service companies are looking to incorporate stablecoins and how we've played a role, and also look ahead and we'll open the floor for Q&A for you to be able to ask anything along the way. So I'm going to turn it over to Hong to talk about blockchain and Web3 broadly.
So great. Thanks, Mike. Hey, everyone. Welcome again to this conference. Thank you for coming out 4 p.m. right before happy hour, and which is the reason why I know most of you are here. So thanks for sitting through with us. Just so we can kind of kick things off, the first thing we want to do is just give a brief history, a look back of how do we get here from a traditional finance, centralized finance point of view, and really hope to demystify blockchain for many of you here who didn't raise your hand and come from traditional financial or fintech industries. And then also look at how do we actually bridge the gap, right? How do we connect the traditional financial institutions as well as the Web3 native, digital native companies through digital tokens or the stable coins that we've talked a lot about. So just looking back, as Mike mentioned, going back to 2011, Paxos was one of many of the companies that started digital native exchanges. We in fact started here in Singapore, so it's great to come back a decade later to see how the industry has grown. And we've really kind of seen two phases of adoption in the traditional finance world. One is starting with digital native companies offering exchanges to buy, sell, trade digital native tokens. And then now the most recent phase is seeing traditional companies, banks included, actually get into the crypto and blockchain space, right? And we'll talk about the reasons why, but we're going to see continued trend of traditional firms adopting blockchain, as well as in parallel, we've seen an explosion of activity in the Web3 world, right? We'll leave everyone here to define what that means. As you can see, a lot of different categories across DAOs, NFTs, metaverse, What this also means is just innovation that's happening globally in a decentralized way. And of course, we're going to continue to see innovation here, but there's going to be an important through line between Web3, right, decentralized finance, as well as traditional finance in order to gain scale. And for traditional financial companies to really look for innovation in the Web3 world to see how we can bring in some of the really incredible use cases that's going to drive financial inclusion, that's going to drive access to efficiency, 24/7 interoperability between different fiat and digital asset currencies. And really, if you look at a case study in how these companies have started to adopt blockchain, we can look at one of our early partners in PayPal. In 2020, in fact, the day I started at Paxos was the week we launched our integration with PayPal. So previous to that integration, right, how did users, you and I, traditional retail customers or institutions get access to crypto? It's through signing up through a crypto native exchange. Coinbase being one, Gemini, Kraken, many others, right? And then to access other Web3, they would convert their dollars into digital currency and send it out. What was happening and what these financial institutions were seeing is a clear flight of deposits away from banks, away from PayPal, away from even broker-dealer exchanges to crypto-native exchanges, right? So the first wave of adoption happened by essentially offering an embedded solution of digitally native buy, sell, hold use cases within trusted platforms like PayPal, like banks, like broker-dealers, and that allowed them to convert their dollars into digital currencies from a buy, sell, hold, invest use case, and more recently with the introduction of transfers, blockchain transfers, which we'll talk about, get access to Web3. So all in all, strategic reasons why this is happening at a breakneck pace, right? One, as I mentioned, traditional companies want to retain deposits, right? Especially banks. And secondly is introduce new customer segments to their growing user base or stagnant user base. And lastly is deepen existing engagement with customers they already have or new customers that they're gaining. And engagement is many-folds. Dan Schulman, the CEO of PayPal, on the first earnings after launching their crypto offering in PayPal and Venmo, mentioned that engagement increased twofolds, or actually was twice as much for customers that were buying and selling crypto on their platform. So those customers are opening up the PayPal app twice as much as the customers that were not engaged with crypto, right? And so that's a really meaningful KPI for many companies here that rely on user interactions. But more broadly, once you have crypto native capabilities in your app, it also opens the door for a lot of other use cases, expanded use cases of what really consumers, institutions are trying to seek more broadly, right? And at the core, we call this digital wallet custody, right? It doesn't matter what type of customer you are. You want safe custody of digital assets, right? There will always be a segment of customers that will manage their own private keys, right? Not your keys, not your crypto. But for a majority of us, just like we don't really like hiding money under the bed or shoveling gold into the walls, right? We want a central custodian, a bank, a financial institution we trust to hold those assets. And for financial institutions, unlike just building a big steel vault and putting money inside, right? Digital assets require a certain level of information security, regulatory, and risk practices. And for these financial institutions, they've looked to regulated custodians like Paxos to provide that safe custody. And around that, a set of services that will continue to increase engagement, access to new customers, increasing deposits, and really enable banks and other FIs to start to offer what they see in previously Web3, right, or decentralized world into their own environments. So to get into that, I'll turn it over now to Mike to talk a little bit about how do we actually look at it from a regulatory and infrastructure point of view to give companies like PayPal access.
Thank you, Hong. So a few different things to remember is I think if you're a regulated entity, it's going to be very hard to partner at scale long-term with an unregulated partner, especially when it comes to anything touching a financial asset. So our view and our belief is that eventually for crypto, for stable coins, for Web3 to be something that's not just the metaverse, eventually that has to be done under the confines and licensing regimens and schemes and regulatory frameworks that most companies are already used to operating under today. So just to go through a slight parallel of some of the different structures that you'll see out there in the market. So, again, we're very proud of our payment institution license from the MAS, and very proud of what that enables. It enables us to offer and operate a digital asset exchange in Singapore. Right? It's really critical for the offering of crypto native assets that people are definitely looking to purchase, to hold, to transfer, to sell, etc. It gives us the power to operate across the entire country of Singapore, for example. Now, if you look at some of the US structure, in the US regimen, you'll see there's a different layer of regulatory oversight. There's the highest level of oversight, which is called a trust. Now, what a trust enables is not just the permission of an exchange, for an example, and the ability to operate nationwide, but what it also does, it actually delegates and quantifies the requirements to the company who are holding the assets on behalf of an end user. So things like having assets bankruptcy remote. So if something, God forbid, happens to the company, that the customer's assets are always secure. And that the customer always has a way of going to get them. And these laws and rules are written in stone. So to operate as a trust in the US, for example, a customer knows fully, or one of our partners like PayPal or Interactive Brokers or Mercado Libre know that their end customers' assets are 100% secure and safeguarded in case anything ever happens to the company Paxos itself. I think that type of security is really important for end customers to feel more confident entering a universe and a world of finance that may be new, may be innovative, and may be very complex. One of the challenges and the gaps to adoption of Web3 and of crypto are some of the old steps and the many steps required along the way for someone 8, 9, or 10 years ago to get access to crypto. They needed their own wallet. They needed to manage keys. They needed to understand their codes. They needed to know how, when, where to access crypto and how not to access it. I don't know about you, but I cannot imagine telling my 70-year-old mother all these steps. Meanwhile, what she wants is to be able to go to her own bank and be able to purchase crypto the way you would any other asset. And I think that's a really important part of licensing and the licensing framework, which is to allow, again, traditional financial companies to enter the digital asset world in a way that their end customers are comfortable and understanding of. Now, you'll also see different levels of licenses in the US, something called an MTL. All an MTL allows is companies to move money around, but it doesn't prescribe any asset guidance. It doesn't prescribe any bankruptcy remote status or structure around how assets are held. So the reason for this slide is to really know the difference in regulatory landscape, and many companies want to know that, again, when they're a fiduciary on behalf of their end customers, that the assets are held in the highest level of safeguarding possible. And I think this will help accelerate crypto, again, from the early adopter phase, the innovator phase, eventually into the mainstream, because people, again, know and trust the asset to a level that they know and trust fiat in many cases today. So one of the most common use cases we've seen are traditional finance companies, fintechs, wallet companies, think digital wallets and neobanks, who are looking to add crypto to the offerings that their customers already have. Maybe they're offering the ability to buy and sell securities or bonds or options, or maybe they're just sending money, through peer-to-peer like Venmo, or they're sending it cross-border like PayPal often does. And what you have here is the ability to add crypto in the same user experience that someone is used to purchasing a stock with. Something ultra simple, simple click through, and again, being able to add it through a single API integration. Now, one of the keys to being able to move any money around the world is proper compliance. So being able to build the KYC, the Know Your Customer, and the AML, the anti-money laundering processes into place, so that, again, the company knows as well that when money is moving, it's happening in the most compliant, secure way possible. But the end user just feels the same user experience that they've always felt. So again, this is really an embedded application into the user interface and the user experience. User capabilities to very simply buy, hold, and sell, to be able to transfer to and from, whether that be sending money to a peer, sending crypto to a peer, be able to do it in the same easy way that they would send money today through a typical peer-to-peer, and some newer asset type functions like lending and staking. Now, staking is a word that really was popular 150 years ago, when there were very wealthy people who lent land to others to farm off of, who lent buildings for people to live in, and then they would recoup some of that investment back over time. Well, that same financial asset, the same financial movement is now entering the crypto world. So being able to securely offer staking or the ability to earn interest on crypto assets the same way, again, someone potentially would with a fiat asset. So what should this look like to the end customer? Well, the end customer should see, again, a very simple, easy, seamless user experience. But behind the scenes, the key is to be able to embed all of this different functionality in a way that the end user never has to worry about any of the steps. The end user doesn't have to worry about where is my crypto, who's securing it, is it safe, is it held properly, or is it going to get hacked, is it going to get lost? Am I doing this legally? Does the company I'm operating through have the proper licensing? Can I trade it with a couple of clicks, or do I have to go through a 20-step process of moving money from a wallet to another wallet, to a MetaMask, to this, to that, that again, most people would never understand, and that gap really precludes a lot of people from being involved. Can I transfer it easily, and can I access really a world of third parties? Now, that third-party world is really where Web3 starts to take over. Because what Web3 really is the ability to take, again, the traditional world and turn it into the virtual world, and to provide very similar types of uses and benefits, but to do it in a seamless, fast, efficient, 24/7 manner. Okay, the banking world today doesn't operate in 24/7, especially cross-border. Inside some countries it does. Inside some countries there are real-time payments, but in most countries, and across border specifically, the Web3 world is the only way you tend to get money movement really in the 24/7 instantaneous path. And the key to be able to do that is, again, integrate the Web3 experience into a traditional financial application using some of these functionalities here. Now, one of the most important aspects of being able to make crypto broad and to make regulators comfortable with crypto as part of the natural financial ecosystem is to know that compliance operations, sanctions screening, money laundering prevention is happening at the same level, if not even a higher level, than happens today with typical fiat. So it's very important that companies are engaging in constant transaction monitoring, being able to map bad actors, and being able to tie bad actors to one another to be able to prevent fraud and prevent any form of money laundering, not just catch it when it does happen. It's this type of high-level security and compliance that has made regulators around the world very comfortable. And if a company cannot provide this type of capability or have a partner that can provide it, it's very unlikely that you'll get a regulated entity to partner in the crypto world or to ever be able to enter the Web3 world with any type of sustainability. So want to dive into stablecoins specifically, because one of the biggest bridges and the most common bridges we see from traditional finance and fintech into crypto toward Web3 is using stable coins, which operate and look like many things people are used to operating with today. So, Hong?
Thank you, Mike. And for everyone here, another question for the group. So how many people actually have stable coins as part of their corporate strategy? I don't assume a lot of you, because a lot of you aren't starting in crypto native. Okay, so we're here to try to change and demystify what stable coins are, because I know that term is being thrown around a lot, right? But really, to Mike's point, stable coins, the term stable, right, and coins, is basically a stable digital version of the asset that backs that stable coin, whether it be dollars or a commodity. So there are different classes of stable coins you can take a look at. Fiat-backed stable coins, primarily US dollars, are backed by a dollar sitting in a reserve account whenever you have an equivalent version of that digital asset in circulation. Primarily what we'll talk about and see here, Paxos issues regulated stable coins where it's backed one-to-one in fiat currency. It's only backed by government-backed instruments, and it has regulatory oversight. We'll talk a lot more about that. USDC, USDT, and others are also part of it. Crypto-backed, like DAI, is backed by not a dollar, but a basket of digital assets. You have commodity-backed tokens. Paxos also issues a gold-backed stablecoin called PaxG, where similarly we have a single troy ounce of gold, or a gold bar, sitting in the Brinks vault in London, and where we issue a digital equivalent of that gold token so that people can easily 24/7 move that value around between participants. And then finally, algorithmic stablecoins. Again, where we're focused, and we'll talk a lot more about, is the reason for prioritizing or preferring one of these over another when we really are talking about how do we ensure stablecoins are actually stable, right? And so that as we think about moving assets to and from traditional finance and Web3 world, that you actually have a dollar that represents a dollar regardless of what happens to the market. So the key benefits of stablecoins, as we look at why is this important, it's of course financial access, right? So with stablecoins, anyone with a cell phone that can have access to a digital wallet can access stablecoins, right? So we're talking about financial inclusion, 24/7 access as a primitive of blockchain. We're disintermediating the issuer relationship. So again, there's a lot of instances in here where you're looking at the democratization of dollars in different countries where there are exchange controls in place potentially. We'll talk a lot more about that. But again, the final point of stablecoins is that it allows for a conversion between a digital currency back to a dollar currency without having to sell off into a fiat currency. And so that access of 24/7 availability becomes really, really critical as we're thinking about, where do stablecoins play a role, right? Whether it's access or the availability, as well as we're starting to see more and more use cases in the corporate world, right? Being able to move value between one another, peer-to-peer, between financial institutions in a truly open ecosystem of blockchain. Let's take a look at also, what's driving the growth of stablecoin adoption. And again, you'll see this move up and to the right, but there has been a blip May of this year. Does anybody know what happened in May that causes the dip? Okay, a few of you. The rest of you were spared, but Rima? Terra Luna, exactly. So there is a cautionary tale we like to touch on here, right? And why stable coins and the lack of regulations become an ire for regulators, and really something that we've been pressing regulators to think more broadly about, and we've been working very closely with our regulators, whether it's the MAS or the DFS in New York, to issue guidances around this. So, Terra Luna was a dollar-backed stablecoin, algorithmic coin, backed by Terra, backed by Luna. And there's a wonderful article on our website, our blog, by our colleague Austin Campbell that talks about really what happened and walks you through the exact chronology of events. But in short, Luna and UST and the Anchor protocol gained significant traction in both retail and institutional investors. There was talk of access and democratization, but the real reason was that they were giving 20% in APR, right? Which is very, very attractive. But the backing of that was somewhat, founded on arbitrage rather than sound, stable currency and backing that value. So if you look at May 6th, right, you had roughly $40 billion of asset value between the UST token and Terra Luna. And a week later, we saw that value drop and later drop to nearly zero, right? And so again, without going into all the specifics of it, it is a tale of what happens when there lacks regulation around stablecoins. So again, the concept of stable currency and digital asset value means that we have to have sufficient oversight, right? There's three areas of regulatory oversight that Paxos and others that issue regulated stablecoins really look at closely with our regulators. One is stablecoin reserve composition, right? A dollar should always be a dollar, and that means that a dollar is backed by cash equivalents, such as treasury bills and other instruments backed by the US government. The amount of reserve funds should also be equal to the amount of assets in circulation. If I hand you a dollar of stablecoin, I better have that dollar sitting somewhere in a bank account safe and sound, so if you ever want that dollar back in fiat, right, there's no run-of-bank situation. And lastly, the segregation from corporate funds, removing commercial risk from the consumer or retail or institutional use cases of stablecoin is incredibly important in having a third party that oversees the issuance, the attestation of that stablecoin, makes sure that it's not the company issuing the token that's telling you what's in reserve, but a trusted third party whose business it is to ensure that there is sufficient value that backs that token in a reserve account. And so there's what we call regulated stablecoins, and we'll talk about what regulated means and unregulated stablecoin. The regulated stablecoins not only has FinCEN and is registered and state-level MTLs, but in the U.S. we have the New York Department of Financial Services as a prudential regulator that oversees the issuance, right, the transparency and the attestation representation of these stablecoins. Today, there are 3 regulated stablecoins: USDP, BUSD, which is also issued by Paxos, and Gemini's GUSD. The unregulated stablecoins, again, while they have registrations with FinCEN, right, it doesn't mean that they have a guaranteed reserve composition requirement. There's no reserve oversight. So even if a stablecoin issuer says, hey, today it's backed by 100% in cash, and maybe we also have had third-party attestation at one point in time, there's nothing that prevents that company from introducing commercial paper or other forms of reserve backing. Whereas from our end, if my colleague Austin were here and if our colleague were here, he often likes to say that if he did anything else to USDP, BUSD other than cash equivalents, he would be handcuffed and hauled off to jail, and the DFS knows exactly where he is. So there's very real consequences to having a regulated stablecoin, and this is recorded. So sorry, Austin, didn't mean to put you on the spot. And again, right, the oversight, transparency, and the guarantee, especially on the bankruptcy remoteness side, ensures that if we are to truly use stablecoin at scale, right, in adoption to replace the fiat equivalent, right, there is a guarantee or there's soundness in place, there's trust in place to know that customers who are receiving or sending stablecoins are actually sending a dollar equivalent in value, or whatever that denomination might be. It could be 1 troy ounce of gold, etc. Right? And so the 2 stablecoins that Paxos issues, and we also have a booth all the way on the other side of the conference hall. We'd encourage everyone to check out Pax Dollar, our USDP, as well as Binance's white-labeled version of our stablecoin, BUSD. In total, we have well over $24 billion of these stablecoins in circulation. What that means is that we are also holding $24 billion of actual US dollars, right, in a reserve bank account. Right? At any point, if our customers want to redeem those stablecoins, we can do so without any risk of those redemptions not being fulfilled. And the other part is, again, as we think about stablecoin adoption, there's also the commercial aspects. Is it the same value if I were to give $1 and get a stablecoin value in return? What we are looking at and promoting in the ecosystem with direct relationships to Binance, BUSD, as well as Paxos, is to eliminate any of those conversion fees so that, again, we can truly create a bridge, right, between traditional finance and Web3. So as you're moving dollar-backed asset or dollar values across the blockchain ecosystem, we truly have a trusted mechanism vehicle for facilitating asset and value transfer. So if we can do this successfully, what does that look like? Well, fortunately, we have one of these examples live. We launched with Mercado Pago in Brazil so that a customer of Mercado Pago can take their Brazilian real, convert it to a USDP stablecoin, right, hold that value in a digital token, and be able to send that dollar between any Mercado Libre, Mercado Pago customer, any Paxos customer, right, or with PayPal, for instance, or Nubank, or our recently approved friends in Israel, Bank Leumi. They can also then send that dollar USDP stablecoin to any blockchain Web3 address, right? to really participate in all the innovation that's happening in Web3. So we're seeing with stablecoins, right, faster, more affordable transfers without significant margin requirements on intermediaries, right, and then also facilitating P2P or payment for goods and service use cases across a global ecosystem of connected partners. And that connected partner happens to either be starting to introduce digital native wallets, as we mentioned through PayPal and Mercado Libre, or being able to facilitate blockchain transfers in a fully compliant way using stablecoins. So I'll wrap it up here and turn it back to Mike on what comes next. How do we actually make this a reality?
Thank you. Actually, I'm going to go back a slide because I think it's important to understand Mercado Pago. Might not be a name that's as familiar in this part of the world, but Mercado Pago is the payments app within Mercado Libre. Mercado Libre is a 145 million user company, the largest tech company in Latin America and South America. They're publicly traded on the New York Stock Exchange, about a $75 billion valuation market cap. The critical thing to understand about their setup is that they are both an e-commerce company and a financial services company. In Brazil and in Argentina, where they're licensed, they cannot touch crypto. They are not allowed. So how do they provide crypto to their end users? They have to find a partner who's able to provide the services, and Mercado Pago actually cannot legally touch crypto. They can't custody it, they can't move the money, they're not responsible for the filings. That is entirely on their partner. In this case, their partner, of course, is Paxos. Now, why do I mention this? Because one of the critical aspects to think about if you're a company that's looking to launch a crypto experience or to enter the Web3 world with a traditional application or traditional financial services company is to think about a few key steps. So number one is putting the company in a regulatory first position, meaning think about where regulation is today, think about where it can be tomorrow, and think about where it can go in the long term. And make sure that the partner that you're working through is someone that can help navigate that and that is set up on the right side of that regulation. Someone who takes regulation very seriously, a partner that thinks about reporting requirements and tax requirements and disclosures as well as compliance and money laundering and all the custody work that we talked about. Now, why is that so critical? Because eventually we believe that all financial movements will be regulated by some entity. And if not today, at some point they will be. Okay, the other thing that's always a paradox in the crypto world is, well, I thought crypto is all about decentralization and the ability of not putting it under any central application. It's like, well, that's true for some experiences. But if you want a large bank, if you want DBS to engage in crypto, if you want JP Morgan to engage in crypto, if you want Microsoft to put crypto inside of LinkedIn or inside of its gaming platform, Xbox, well, then they're all regulated companies. They cannot work with a fully decentralized anonymous partner. So it's a really critical part of, again, bridging crypto from the early adopter phase into the enterprise grade, full mainstream where it could be broadly accepted and trusted across border and across company. The second is think about an infrastructure partner. So one of the reasons PayPal chose to work with Paxos is because we have no interest in their end customer. PayPal, Venmo, they are responsible for the end customer. They want to build an amazing UI for their customers. We are purely in the background. We're very boring. We're all the plumbing underneath. Okay, they don't have to worry about it. Okay, but we're also never competing for their end customer. And I think that's a really important aspect for a large company that has retail footing to know that the infrastructure provider is solely behind the scenes, and that's a really important part of helping them get to scale. Third is think about reliability and service. So when you think about the speed of crypto and how many transactions per second happen, it blows the banking system out of the water because it's also happening 24/7. So it's not just about speed and scale of transaction, it's also about the security of those transactions. And every day, every week, we hear about another hack from a wormhole, from wallets, from many of the bridges that are out there, and some of them are in the hundreds of millions, if not the billion-dollar range. Okay, we believe that that has to be an impossibility. If we're going to support the likes of a $400 billion customer like MasterCard or a $100 billion company like PayPal, that can never be a risk. It can't be a 1% chance. It can't be a 0.1% chance. It has to be zero, which means you have to also audit and go through all the SOC compliance and all the SOC attestations for companies to trust that, again, their customers' assets are secure, safeguarded, and transparently held in custody. Otherwise, it's going to be very hard, again, to kind of bridge that gap. So when I look at these companies that we work with, again, PicPay, 53 million users. MasterCard has obviously been around 50, 60 years across the payment world. Hong mentioned Bank Leumi, which is the first bank in Israel to be able to offer crypto. Just got approval from the regulators there, I believe, 2 days ago. 2 days ago. Mercado Libre, PayPal, et cetera. Okay. What do all these companies have in common? They're either all publicly traded or they're regulated banks. And there was a point in time where I believe no one thought banks would ever enter crypto. That's the enemy of banks. And I think what banks have realized, what Hong mentioned before, if they're going to retain the money in the bank account, if they're going to retain end customers, and if they're going to be able to attract the next generation of end customers, that they better be able to enter the digital world and eventually build a full Web3 experience for those users where they can move their money 24/7. They could borrow against their assets just like they could borrow against securities today, and to be able to have the same type of financial flexibility with crypto and with stablecoin as they do with their Singaporean dollar, their UK pound, their US dollar or whatever. That's a really important step to be able to get to. So when I look at MasterCard and what MasterCard is looking to do, just as a perfect example of turning the traditional financial world as a partner to the crypto world and vice versa. MasterCard has merchants receiving payment in crypto all the time, right? They work with Binance, they work with other exchanges, they work with many where crypto is constantly flowing through their system. The problem is MasterCard can only settle with its banks every 2 business days. So what's happening is there's money movement happening behind the scenes, but MasterCard cannot settle with that merchant for 2 full business days. This is a major problem because it creates a liquidity gap. And it means that there are end customers who are not getting access to their money in as fast a time as MasterCard wants to be able to settle to them. So they've partnered with Paxos to be able to provide settlement through a stablecoin. Now, beautiful thing about a stablecoin, it runs 24/7. It runs globally. So without going through all the details here for time, what MasterCard is now able to do is settle with its banks, its issuer banks, in a T0 or T+1 fashion. So those crypto native merchants are now able to access their cash from stablecoin back into fiat and vice versa in a very fast, efficient manner, and again can do that globally effortlessly. It's a huge advantage for them. We've also announced a new partnership with MasterCard where we are their crypto custody partner globally, and they're going to be able to resell crypto to banks and issuers across the world at this point. So any financial service company will be able to provide crypto as a service to its end user using Paxos. So how to integrate? Again, start with the basics of buy, sell, hold, because that's an experience that most retail customers are used to. Then enable them to enter the next phase of Web3, which is how do I take crypto from the crypto world and move it potentially into the traditional world? How do I send it to my mom for her birthday? I gave each of my sisters $100 in Bitcoin last year for Christmas. They remind me every day that $100 is now only worth 44. So I owe them apparently 56 extra dollars this year to make up for the cyclicality of Bitcoin, unfortunately. Allow them to stake it. And then when you think about what Web3 can be in phase 3, it's how do I borrow against my crypto? How do I buy NFTs? How do I take a physical asset and turn it into a digital license? If I'm Live Nation or Ticketmaster or one of these large promotional or gaming companies, how do I sell a physical good or a license to something or a ticket, but now do it digitally? Well, to do that, again, I'm going to need to KYC the user because I'm going to need their money. I'm going to need to be able to send them that ticket 24/7. I'm going to need to be able to transfer that if I want to send it to someone else. So it's a perfect Web3 example where NFTs really become the future of licensing and the future of individual ownership stake, but to do it again on a blockchain path. So I'll pause here. I know we spoke for a solid 42 minutes, so want to make sure we give this group time for questions. So we'll pause there, and I believe we have a guide. Thank you, Becky. So for questions? Oh.
Any questions?
Yes, we have one. Is that on? There you go.
Yeah, so my question was when you are minting or redeeming USDP or BUSD, the integration, is it possible to do it with non-USD currencies? So can I send Singapore dollars or euros to Paxos and mint USDP or any other stablecoin from that?
So today we have it in Brazil, for example. So a Brazilian customer is able to use the Brazilian real and purchase USDP or crypto native. We are able to facilitate the FX transaction through the user experience that Mercado Libre and Mercado Pago have built in Brazil. So today for BUSD, currently it's US dollars only, right? But if whatever the app is that's facilitating the purchase, if they want to facilitate the intake in Singaporean dollars or rupees or any other currency, that FX can happen and then the purchase would still happen in dollars because that's what BUSD is still denominated in.
Yeah, and we actually have, I've had several conversations with remittance and payment companies here, and how do you enable your customers to receive a crypto payment? You could do it, to Mike's point, right? We're actually enabling that payment company to receive crypto and immediately do a back-to-back transaction to sell it for fiat, and then they can do their normal day-to-day business, which is converting one fiat to another. So there are a number of different ways that we can, again, bridge the gap between fiat currencies, digital payments, and so it really also comes down to regulations. We think about it as a two-sided token, right? What's the regulatory consideration, and what's the infrastructure needs. Infrastructure is always a lot easier, but as we look at market-to-market regulations catching up around the world, we take a more bespoke approach. But there are a lot of these conversations that are happening where we're facilitating, cross-border remittance use cases at scale, right, using stable coins or other digital assets as a facilitator.
Other questions? All the way on the side. He's almost here. So just over.
Hi. No, I have a rough idea, but can you do a staking 101 for all of us?
Staking. Hong, you're a staking expert.
Yeah, I wouldn't call myself an expert, but so the long and short is for us as a regulated entity, right? We're going to have to partner with companies that offer validator nodes, and we'll work. There's two sides. What's the commercial and sort of regulatory compliance piece, and then what's the technology integration? So Mike mentioned earlier we have ecosystem partners, and a number of these partners like the Block Daemons, the Figments of the world, they'll offer actually the tech behind staking. What we do is we hold safe custody of those digital assets, again, fully segregated from corporate assets, bankruptcy remote, right, and pledge those assets to get staked. And through a commercial relationship with the validator company, with the UI, whether it's Mercado Libre or PayPal as an example, offer it downstream to their customers. So we ourselves may get into the validator business ourselves, but as an initial step, we would look to our partners to provide that.
Fed or a FDIC insured institution in the US and sort of differentiate that with what happens in staking, because it's very proximate.
So we're a trust company. So as a trust, we actually have to hold the underlying asset. And therefore, we have to be able to redeem the asset at any time, which also means there could be a third party involved that technically gets ownership custody over that asset in the case something happens. Okay? That's why we do not directly provide it. Now, FDIC is a very specific thing. That's about cash, in certain FDIC-insured bank accounts across the United States up to $250,000. When you stake an asset, you're losing that FDIC type of coverage. But if the asset's held in a trust, for example, in Paxos, the asset's always going to be there. The customer would have to agree for that asset to be liquidated at some point, so we would only be able to liquidate basically through a tri-party agreement between the end customer, Paxos, and the staking entity. And yeah.
You also have underlying sort of cash assets to back up as a prudential measure out of your own volition when you custody those assets.
I'm sorry, what do you mean by that?
Do you have a like in case of stable coins, you would have reserves that are liquid and cash equivalents. In this case also, do you sort of have a similar arrangement behind those?
Correct.
Okay.
Same.
Okay.
Yeah. The custody doesn't change in that case. The custody backing does not change, at least.
Yeah,
yes. Other questions?
Hey, hi, I'm Shani Sim. Thanks for great sharing today. I have one question actually regarding the regulation. So just now you guys mentioned actually you guys get a license from MAS and you guys can provide the white label solutions for any traditional finance company who wants to provide the crypto capability. So my question is, if let's say our company, we don't have a license about the crypto offering, but you guys have it, and when we actually guys are using your white label service, do we have to get extra license actually in order to provide that? Or your guys' license can cover everything for
Are
this?
you based in Singapore?
Yes, we are.
I think that's a great question for your legal team. We cannot give your company the legal counsel. However, what we do know is that we have the license to power that experience. There probably are circumstances that if you're regulated already by the MAS in Singapore, that the MAS may require you to get some form of license. Part, all, half, that's really completely dependent on the type of business you run. We cannot give you that advice, but we're happy to help you explore that conversation if the time comes.
Yeah, come find us. We actually have our head of compliance in Singapore that can.
We're about
at
5
least help you
kilometers
answer
that
the
way.
question.
Although,
Yeah.
yeah, you have to fly there by
One
helicopter.
hall is 1 kilometer here.
Hi. So my question is, how do you see the future of the USDT, and also how do you see the competition between the stablecoin, vice versa, like CBDC in the future? Thank you.
So I'll start, Hong, if you want to jump in. So USDT has gone through quite a transformation in the past year. They've changed some of their reserve backing. They're now no longer in commercial paper. It does seem like there's some attempt to look to transform the reserves to looking more like cash and cash equivalents. I think they have a long way to go. Now, Tether has obviously built quite a brand, and it's built huge backing, 70 billion, 80 billion, whatever the number is today. It's a gigantic number. You can't argue that. But I do think when you look at what happened with Luna and Terra, that there is more scrutiny behind what is underneath a stablecoin. And you know, when a stablecoin is not backed by cash and cash equivalents, it may offer some upside. At the same time, if the market changes or the market shifts or if something happens within the risk portfolio of the stablecoin backing, the entire thing can just disappear. And I think that's terrifying for most people. So I would say that's a really important thing to consider is like, are the reserves truly backed? Are they bankruptcy remote? How are they, how are they redeemable? What's the liquidity behind the redemption? It's not just the backing, it's also the liquidity. Because if a lot of people want to access the Tether dollar back, how quickly can they actually get access to it? And what happens is if a lot of people want it soon and they can't get it, the price will depeg. And then you actually create an accelerated drop in value on the underlying token. And we've seen that happen now, with their token. In terms of CBDCs, through a US lens, the chairman of the Federal Reserve has indicated there's probably a world where CBDCs exist alongside private stablecoins. What I think has to happen though, just like in the US, I could take a US dollar issued from one bank and bring it to another bank and it's the same thing. Well, eventually there have to be uniform standards of what a stablecoin dollar really means. And therefore anyone can accept it and redeem it interchangeably. I think there's work to be done on designing those guidelines. And I think other countries are going to operate CBDCs in a much more centralized way, looking more like what China's done. Turkey's just indicated it's going to be issuing a digital currency. And then you've also seen many smaller countries come up with the idea of a digital form of money, not necessarily a CBDC, but just really a faster, easier access to money movement around their country. And the first place we'll probably see central bank digital currencies is bank to bank and government to bank transfers because they control it. It's already under the auspice of how those central banks tend to move money, and it will give them faster access to changing the money supply as needed. But I think we're going to be a ways away, at least in the US, from seeing CBDCs enter the mainstream retail realm. I don't know if you have any other thoughts on Tether or CBDC.
No, that's perfect.
Thank you.
Okay, thank you. Hi. Sorry for my husky voice, too much more talking.
I understand.
I have a question. What do you think about transparency? Because I think it calls and it ties in a bit to the former question is, for the end user, transparency of the reserve, of the stablecoin reserve is an important fact, but it's not going to be on-chain, right? It's going to be off-chain. So how could that look like?
Yeah, it's a really good question. I think as we start to, again, see adoption grow from early adopters to mainstream, the regulations will catch up. I think companies that specialize in this area will catch up. Today, you have traditional auditors that already provide attestation on physical and traditional assets, right? For example, our Paxos is backed by physical gold. We have auditors that will attest to the actual reserves in gold and look at that backing against the stable coins. And so I think that's critically important. That will continue to be sort of a North Star around how traditional firms will look at attestations. But you bring up a good point. What happens if we do move into fully digital native world? How do auditors, or how do we potentially decentralize auditing to a point where it's fully immersed in Web3 or digital native blockchain environments? So that's to be seen, right, on how that will play out.
I will say I do not think the auditors have moved as fast as the digital world has. Ernst & Young is still learning, Deloitte is still learning, KPMG is still learning. Some of them are doing it at their own pace. But there's a lot more movement, I think, that they will have to see, but to truly be able to grasp what will it require to audit and attest to digital assets that are both on and off chain. But that's in progress.
But how could that look like for an end user? Because I know as an end user on chain, I go on Blockchain Explorer, right? Like what, and just an idea if you have that, like how could an end user have this kind of trust and security?
So I would say 99.99% of end users do not have a clue how to find out what their tokens are on chain even, right? Someone's gonna have to teach them. And again, if you go to the broad world where billions of people are holding crypto, I think the vast majority will not have a clue where their crypto is, how to find it. Just like today, most people don't actually know where their money is even in their bank account, right? And that the bank's lent it out, and like, when do I get it back? How do I get it back? All that. So I think that's one thing just to keep in mind. The second, for example, in the US, we have to publish those audits. Those audits for us get published on a monthly basis, down to the QSIP level, which is the specific security we are holding, the treasury certificate we are holding behind the cash equivalent, right, that we have in there. Those have to be published. I think a similar type of framework has to happen for all forms of digital assets, and we're starting to see some of those guidelines developed. In the US, the NYDFS has started it, the New York Department of Financial Services, that's our main regulator. I think other regulators are starting to come forth with that type of transparency, and over time we'll have to be able to get it to where you can open your own personal account and be able to say, okay, here's my money on chain, here's my money off chain, and where is it off chain? And how do I get access to it? And that's got to be very transparent as well. Otherwise, again, I think people will fear entering that world. Yeah.
One maybe analogy to that, or one example of that, is if today you go to Paxos and you hold a Pax-G stable currency, right? You can actually look up the serial number behind the bars that represent that value and token, that essentially 1 troy ounce of physical gold, and the serial number behind that. So I think the nature of a stable currency or a reserve-backed currency means that there is a physical reserve somewhere. So we are going to rely on regulators to provide oversight, to provide that trust for consumers and for institutions to, again, believe that what they actually hold as supposedly an equivalent stable currency, right, with equivalent reserve and backing is actually backed by that reserve or that asset somewhere. So I'm not sure if we'll truly go to a fully blockchain-enabled world. And to Mike's point, do we even care? Right? Once we know that and trust that what we hold is actually the value that we are being told, just like you go to a bank, you don't question that the dollar you have is actually worth $1, right? The paper or the cotton actually that you hold in hand is guaranteed by the bank, right? And so we need regulators to provide that guarantee and oversight in order for consumer trust and adoption to start to ebb over from early adopter into the mainstream adoption phase.
The two caveats to that I would say are not all regulators are created equal, right? And if you tell someone in Cyprus that their bank account had $100 in it, now it had $5, right? In 2013, I think that was, right? And in many countries, we work with customers in Brazil and Central America and many other countries where there isn't the same level of trust in a regulator, and there isn't the same level of trust in their bank. And for them to be able to get access to US dollars digitally, that may be the only way they get access to US dollars. In Argentina, there's a system called Caves, where they literally go to a back alley store to be able to convert money if they have dollars. That's not the way it should be. Right? And I think the goal is to be able to clean that up and make it really easy for people to transact, again, in a transparent, trustworthy way. But we know not every experience is going to be the same. And not every country has the same history to be able to build that type of trust. So blockchain enables people to gain trust in a decentralized way, but in a transparent way. And hopefully that helps us bridge, the gap. I think, do we have time for one more? Or one more, last one.
Hi, thanks. So with the growth of blockchain being more accepted in the financial world, finance being far easy to flow here and there and be accessed by anyone and everyone, do you think that there will be some concern that institutions and banks will hold too much power? I mean, as the banks get more liquidity to play around with, they get over-leveraged and the government has to bail them out. Could there be some credit crunch?
That's a really hard question to answer in 60 seconds. I would say a few things. Number one, you're seeing the growth of non-banks in the banking world. Fintechs that are entering banking services, decentralized wallets that are entering the lending world and the borrowing world, which was typically owned only by the banks. I think when you say credit and credit crunch and being over-leveraged, that's something that is really a vestige of the old banking world and a fiat world where they only keep 8 to 10% of the cash and lend out 90 to 92% of it, which means that if they make bad loans or they're not properly underwriting their customers, when the money comes back, it might not come back in full, and then when you want your money, you won't be able to get it. Blockchain gets rid of that because everything is documented, it's automated, it's fully ledgered out, so it's very hard to kind of have that credit gap, right, that you would typically see, again, in the more traditional banking world. The other thing that you have with blockchain is a faster process to underwrite because you can use more aspects of someone's financial well-being to underwrite them for lending. Or, like we mentioned before with the custody protocol, if one entity is custodying the asset and you want to borrow against it, you can automate the liquidation if someone's value falls below a certain level, just like that happens today with securities. The problem with the securities world is that when you sell a security, at least in the US and most parts of the global stock exchange system, it takes 1, 2, or 3 business days for the cash to actually come back. So in that 2-3 business day gap, there's a lot of risk. And when you move securities to the blockchain, which eventually will happen, it's something Paxos does, we settle securities today in the United States through a blockchain, part of a pilot with the SEC, where we settle in T0. So when you think back to what happened to Robinhood in 2021, there were $6 billion in the hole to the NSCC in the US because of how much risk there was in their portfolio. Blockchain eliminates that. So the credit risk goes away almost to zero. The overnight cost goes away. The collateralization requirements go away. So I really believe blockchain is a potential solution to that in the modern financial world.
Yeah. And I'll just close with one other thought, which is that, while there's incredible amounts of innovation happening in Web3, and in fact, that's the innovation that's driving traditional financial companies to actually move to look at blockchain. And for us, it's been incredibly rewarding and interesting and insightful and surprising to see many of the largest financial institutions in the world who 2 years ago would not touch blockchain, right, to start to actually make blockchain a critical and prioritized item on their roadmaps. And so that's all because there's this explosion of innovation happening in Web3 and this need and desire to catch up and follow the money, right? Because otherwise, consumers will take their money, leave the institutions so they can seek, access to financial products elsewhere. So this is all really encouraging to see, and I think the people who haven't raised their hands today, we hope that you've taken something away from this presentation. Please find us if you have any questions after the fact. And again, to start to look at how to include blockchain, how to include wallets in your own apps, how to include a strategy around stablecoins to move value between traditional finance or the fiat world and the blockchain world. And then for the Web3 companies to continue to drive innovation, continue to do what you do, and then also just keep an eye on, where there's actually scale is going to be the one day getting consumers or the traditional financial companies to adopt the products that you build to really drive scale and adoption from, again, early adoption phase to the mainstream and really get traction to proliferate access to the wonderful products that we're all creating collectively here.
Awesome.
Thank you.
Our CEO is on stage now, on the product stage, so we're going to head
Great.
over that way. Thank you all for your time this afternoon.
Thanks, everyone.
Much appreciated.